Very good morning. Today, I would like to explain about the different types of loans in India. Usually, the loans can be divided into two types: secured loans and unsecured loans. Secured loans are those loans that are provided against security. Yes, security means collateral. The loans on any collateral. The collateral may be in any form, any assets, land or house, whatever may be, any equipments and assets. So the banks provides any loans that are against that collateral or security, which are known as secured loans. Here, the borrowers need to furnish security for availing of security loans. It's mandatory. If the person wants to take any security loans, they have to give any collateral. For example, um, we want to take any mortgage loan, we have to give our house as a collateral. If you want to take any housing loan, construct the house, we have to produce our original property document to the bank. So these are the security purpose they are keeping. They are going to keep as a security in to avoid the future risk of not repaying the loan. So in the case of secured loans, lenders face a lower risk of default by the borrower because the bank side is safe side now. In case if the borrower will not pay the amount to the bank easily will sell the collateral asset and claim the amount from the borrower. So there's a lower risk side to the bank. In case of the borrower is unable to repay the loan, then the lender can steal the asset to recover its dues. So, because secured loans interest rate is usually less when compared with unsecured loans, because since that the borrower giving their asset as a collateral, so it's reducing that risk of lenders. They are charging very less interest on loans. The main reason why secured loans carry the lower interest rate than the unsecured loans. Then another type is unsecured loans. If any borrower take a loans from the bank without giving any security or collateral, which is known as unsecured loans. So unsecured loans are provided against the income or the prosperity income and capacity of the borrower. For example, personal loan. Here to take, we can apply and take a loan from any banks. Here, no need to provide any asset or collateral or things to the bank. So regarding unsecured loan, the borrowers are not required to furnish any securities. The lenders extend unsecured loans based on the documents provided to the borrower, their income potential, and the civil history. Of course, the bank, whenever we apply for any loans, immediately the bank will check our credit worthiness by seeing or verifying the civil report. Unsecured loans increase the risk of lender because the banks not collect any collateral there, so it increase the risk of lender. That's why interest rate also little high than the secured loans. Here the um, personal loan usually we can take example of unsecured loans. Housing loans and mortgage loan come under the secured loans. Okay, let's be explain one by one what are the items that comes under the secured loans and the unsecured loans. First, the secured loans, housing loans. I know that we know that the word is housing loans. To construct the housing loans, we can take a housing loans. The range it maybe 10 years to 30, maybe maximum 30 years, based on that age and credit worthiness of the person. Then here loan amount LTV value, there is LTV ratio there, usually they follow. It means the borrower can avail a loan up to 80% of the property values. Actually, if you provide any asset as a collateral, in that value, the collateral value, 80% of the value only they will provide as a loan. That is called as loan to value. Then gold loans. Usually, Muthoot Finance is there, the private finance also they are providing gold loans, government banks, and here that LT value is 90% because you know that the gold rate is every day is increasing and the high fluctuation and volatility. That's why the okay even the banks are providing 90% value of that asset as a loan. Then vehicle loans. So we know that to buy a new vehicles, the banks provides a loan. There is also secured loans. Here, what securities we can give? That even registrations and RC book we have to give to the bank as a security. Then loan against property. So like mortgage loan, we can take any loan on any properties. Even if it's an equipment assets also we can take a loan on. Then loan against the securities. Here the securities means the government that stock, equity shares, bond, mutual funds, debentures. We can use these also as a security and we can avail a loan from the bank. But the LTV value is 50% because we know that share values and mutual funds, bonds, and debentures having high volatility in the markets. Anytime till there is a risk, we know that that's why in the share market there is a risk, and that's why the loan LTV value is 50% of the security value. These are the then title loans. Title loans means lender provides loan to the borrower against their vehicle. Here the borrowers can borrow up to 25%, 50% in value of their vehicle by handing over their vehicles as a collateral security to the loans. While the possession of the vehicle remains with the borrower, in case of default, the lender may seize the vehicle. Here title loan means just transferring the rights of that title only to the bank as a security. The LT value is 25% into 50. Loan against fixed deposit also, we can use as a security fixed deposit. We can take a loan on fixed deposit amount. The loan against insurance, we can use insurance policy. But the condition is the policy must have surrender value. So LTV also 85% to 90%. That policy surrender value is, for example, 1 lakh. Up to 90,000 we can take a loan. Also, we secure loans. Usually, we think that okay, asset and land only we can use as securities. But here, that we can use the RC book, registration book of vehicles, any fixed deposit, insurance policies, then shares, mutual funds, and debentures. These also can be used as securities, and we can avail the loan from the bank. So these are the examples of secured loans.